From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It's 30 minutes into the U.S. trading day on this Wednesday, March 16th. Here are the top market stories we are following for you at this hour. Pleading for peace. Ukrainian President Zelensky makes an emotional plea to Congress, asking for help to defend his country's skies. Meanwhile, Russia says a neutral Ukraine with its own armed forces could be a compromise, hinting at possible progress in talks. Decision day, the Fed is set to hike 25 basis points today. We know that. What will matter, the dot plot, the projections, and Powell's news conference. We'll preview it all with Bruce Richards of Marathon Asset Management. And Plunge Patrol, Beijing swoops in to intervene in the sell-off in Chinese assets, pledging support for financial markets and the economy. It boosts risk sentiment in Asia and around the world. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alix Steel is off today. Welcome to Bloomberg Markets. And Guy, while it is Fed Day, Chairman Powell will be taking the podium later. It was President Zelensky who took the podium first with an impassioned plea to Congress.
Absolutely. A standing
Russia
ovation.
has turned the Ukrainian sky into a source of death for thousands of people. Is this a lot to ask for, to create a no-fly zone over Ukraine to save people? Is this too much to ask? Humanitarian no-fly zone.
Joining us now, Kaylee, Bloomberg's Washington correspondent Amory Hordern. She joins us from Capitol Hill. Amory, the call was clear. Shut the skies or give us aircraft. How is the U.S. going to respond?
Well, we're going to be hearing from the president, Guy, as well, just before noon today in Washington, D.C. And really, President Zelensky there made this plea at the end, speaking in English directly to the president. His tone and sentiment, obviously, incredibly emotional, imploring Congress to act to ratchet up the pressure on the administration. But it was interesting, when he renewed his plea for that no-fly zone, he said, if that is too much to ask, then give us the air defense we need so we can protect our skies. And this all became as well, came before he showed a really graphic, horrific video showing exactly what is going on the ground in Ukraine. And then that ended with a black slate, just asking Congress yet again to close the skies.
Yeah, Anne-Marie, it absolutely tugs on the heartstrings. So let's talk about how Congress would respond. Is it going to take congressional pressure to get the Biden administration to move on this?
It potentially will, and we've already seen some of that. When it comes to a no-fly zone, there is bipartisan support to not go there yet. President Biden has said this would mean World War III. Jen Psaki was asked about this yesterday, briefing the press, and the message from the White House is that they believe this would be escalatory and that Russia would view that as the U.S. or a NATO member entering this conflict directly. But when it comes to sending them those Polish fighter jets, there is already some Republican support for that. And I imagine the pressure is just going to be ratcheted up after this really emotional plea from President Zelensky.
Amory, we understand that there's also been a conversation between the Russians and the Americans regarding weapons being sent to Ukraine from the West. The Russians want it to stop. Is there any chance that that happens?
I don't see that happening, as the president just before noon is going to talk about the military aid they are sending to Ukraine and the billions of dollars they are helping Ukraine in terms of not just military, but also humanitarian efforts and economic efforts. This call, we have yet to hear the U.S. readout. All we know right now is what Interfax is reporting. But we spoke about this yesterday on this show. Jake Sullivan, the president's national security advisor, was seeking a call with Nikolai Patrushev. That is his counterpart in Russia. He is the secretary of Russia's National Security Council. And what the United States was seeking that call was to warn the Kremlin about the use of chemical and biological weapons. Right now, we're hearing just from Moscow is that Russians have asked and warned about stopping supply to Ukraine.
Anne-Marie, we've talked a lot about potential aid that the U.S. could give in the ongoing conflict. Let's talk about the role it could play in eventual peace, perhaps. We had the Kremlin earlier saying that a neutral Ukraine with its own armed forces could be a compromise. Ukraine saying it needs security guarantees. What role would the U.S. feasibly play in that?
Well, I imagine the U.S. would play a role in terms of security guarantees. That's what Ukraine would ask for, security guarantees from NATO, which the United States is part of potentially. But we should note when it comes to the diplomacy, there are tons of headlines coming out from Moscow, from Kiev, and they are in the middle of these negotiations. We need to be very careful with how we read, especially the markets, how they read any of these signals and potential posturing from both of these channels. And we should note that it is hard at times to take the Kremlin at face value, given the fact that you just have President Putin right now also on state TV talking about the need to protect a sovereign Russia as Russia is invading a sovereign country of Ukraine. We should also note, weeks before the invasion, for weeks, the Kremlin had maintained that they had no plans to invade Ukraine. Obviously, we know that is not true.
Anne-Marie, final quick question. Congress looked united today. Does it extend any further than simply the US's response to the Ukrainian crisis? Is this going to be a pivotal moment politically, domestically in the United States?
It is a pivotal moment domestically when it comes to this issue, Guy. And I think you bring up a really good point. It's this issue that has brought Republicans and Democrats together. Yes, there are fractures in that relationship even when it comes to this issue. Yesterday, we heard from Senate Minority Leader McConnell talking about the fact that he thinks the administration is dragging their feet. And remember, when the White House came out with the import ban on Russian crude and other fossil fuel products, that really was pushed ahead, and the pressure came from Congress, from Capitol Hill. But right now, they are united when it comes to Ukraine. I don't see that at the moment extending to other domestic issues.
All right, so we'll see how pressure from Capitol Hill regarding those jets and other issues that Zelensky has raised today may come forward. Thank you so much to Bloomberg's Anne-Marie Horton reporting from the U.S. Capitol. Now, coming up in just a few hours, we'll find out how aggressive Fed policymakers are when it comes to fighting inflation amid an ongoing war in Ukraine. We'll get a preview and the perspective from Citigroup's global chief economist, Nathan Sheets. This is Bloomberg. The Federal Reserve is set to raise interest rates for the first time since 2018 later today. Policymakers all but certain to boost the rates by a quarter percentage point at the end of their two-day meeting. Joining us now, Citi Global Chief Economist Nathan Sheets. He's a former Treasury Undersecretary and was director of the International Finance Division at the Federal Reserve. Nathan, 25 basis points is the move. Chairman Powell has all but directly told us that. So what could constitute a hawkish surprise out of the Federal Reserve today?
I think this is a defining moment for the Federal Reserve, and I agree that the question is not so much where does policy go. The 25 basis point move has been well telegraphed, but I think it's about tone, it's about analysis, it's about the Fed's take. How worried are they about stagflation? On the one hand, yes, inflation is running hot. On the other hand, we're also seeing a massive increase in global economic uncertainty and stresses arising from that. And how does the Fed balance those challenges? So I think here, hawkish would be more of an emphasis on the inflation risk that we face and a downplaying of some of the growth implications of this episode.
Nathan, presumably at some point high inflation will impact growth. How do they deal with that?
Well, they say that the best cure for high prices is high prices, but that happens through demand destruction. And I would say that with inflation running at the pace that it's at, that's a risk going forward. That said, for the moment, it feels that the consumer in particular has continued to be pretty well positioned to be able to manage through the price increases as a result of the hot labor market and also strong balance sheets. But that may be ultimately where this thing lands, is particularly some of the higher commodities and materials prices end up being a tax and a headwind on spending, and the economy in some sense kind of cools itself. But that's probably 6 to 12 months down the road, I would say. I'm not sure the Fed wants to wait that long to get some traction on this problem.
All right, so demand destruction may be a little bit farther away. Obviously, when it comes to inflation forecasts, we will get new projections out of the Fed today. We will also get a new dot plot. Nathan, what matters more, the number of dots in 2022 or the terminal rate all the way at the far right side of the chart?
I'd say they're both very important. My expectation is that the Fed will be hiking rates most likely at every meeting in 2022. I'm not sure that they're going to be willing to admit that in their dot plot, so maybe it's 5 or 6 hikes. But I do think that's important. But I also think that terminal rate is something that longer-term investors, particularly in the bond market, watch very closely. And if we were to see that in this episode migrate up, I think the long end of the yield curve would definitely notice that, and that could be a source of volatility. I would be surprised if we saw at this point any meaningful shifts in that terminal rate. But if it happened, it would be quite significant.
Nathan, you talk about volatility. You're an expert in building economic models. How is your economic model coping right now with the kind of volatility that we're seeing? The inputs are all over the place. Oil is just one of them. Huge volatility there, but you're seeing it in other inputs as well. What are you getting out of the model right now? What are you putting into the model right now? How effective is it in terms of giving us an idea about where we go from here? What I'm really asking is, how much certainty do you have about the course that the US economy is on?
I don't want to overstate, but I think in this environment, when there is such a potpourri of shocks, we're looking at energy shocks, we're looking at a massive increase in just global uncertainty. At the same time, we're still fighting a pandemic and we're worried about lockdowns, even as we speak, in Asia, that the guidance that our models can give us are very, very limited. And I think that, we're going more right now just by gut instinct and thinking about, well, what are some plausible scenarios? And one scenario is there's enough momentum to get through this, and that the global tensions are resolved fairly quickly, and the global economy is able to go on its way again, maybe with a half point or so less growth than we were expecting a few months ago. But I think we've also got to substantially mark up our probabilities of global recession, and that there are various other kinds of nonlinear shocks.
If I could just jump in there, what do you see currently, given, yes, how cloudy and uncertain things are, the probability of that recession is?
For the global economy, I think 1 in 3 that we see a very marked and sustained slowdown in global growth. I think the reality is that Russia and Ukraine are big materials exporters. And to the extent that tensions there are persistent, the disruptions in materials supplies could be very, very substantial. I would say that the United States is probably a degree removed, and maybe the probability here is a little lower, maybe like 1 in 4. But if, as Greenspan said once, the United States can't long remain an oasis of stability. So if we're seeing these big shocks in the rest of the world, the U.S. has more momentum, but it wouldn't last an appreciable period.
Nathan, if we see increasingly the global economy retreating from globalization and falling into spheres of influence that are going to impact supply chains and trade routes, are we moving into a world of structurally lower growth, structurally higher inflation, and higher rates?
Guy, I think the deglobalization in the aftermath of this string of shocks that we've seen goes back to the trade wars, the pandemic, the disruptions in supply chains, and now this ongoing geopolitical situation that we have. I think the prospects for deglobalization are meaningful. And as we deglobalize, that means fragmentation. And fragmentation suggests less efficiency for the global economy. And the implication of that would be softer, weaker global growth. Now, parameterizing all of those effects is very hard. What exactly, how much weaker? But, could it be a quarter percentage point weaker? Absolutely. And if you think about that relative to baseline growth of 3 or 3.5%, and aggregate that up over a number of years, that's quite substantial in terms of human welfare.
On that note, that slightly gloomy note, Nathan, we will leave it. Thank you very much indeed for your input today. Really appreciate it. Nathan Sheets of Citi, thank you very much indeed. What have we got coming up for you next? The clock is ticking on Russia and some of its dollar debt. One ratings firm is already warning that Moscow is on the verge of a default. We will talk about this next. This is Bloomberg. I just want to draw your attention to the front page of the Financial Times right now. I know we probably shouldn't be pointing you in that direction, but let me do it anyway because it's having a market impact. The front page of the FT website says that Ukraine and Russia, Kayleigh, drawing up neutrality plans to end the war. How exactly that is going to work, we don't know, but the FT is pointing to a 15-point draft plan that would involve Kiev renouncing NATO membership ambitions in return for security guarantees. The devil is going to be in the detail in all of this. There was a report coming from a Ukrainian aide a little earlier on saying that this is where the talks are. It's about security guarantees. But we are seeing a market reaction to this. We are seeing yields picking up, the dollar down on the back of this report, Kayleigh. It does sound as if maybe this is the direction of travel at the moment. But as we've seen before, details matter. And I imagine every single one of those 15 points is going to be debated very closely.
Yeah, absolutely. I would note that in terms of the market reaction, Guy, you're also seeing it showing up in oil. It's been fluctuating throughout the day, but sending it back into negative territory on the prospect that potentially a plan to end the war would mean less supply disruption. And then you're also seeing stocks at session highs. I know we barely blink at a 3% move anymore, but that's how high up Europe is on the day. And the NASDAQ 100 is getting near that territory, Guy.
One of the interesting aspects to all of this is, were we to see some sort of a ceasefire, and it appears that there's a lot to talk about here, were we to see some sort of a ceasefire, what would that mean in terms of the sanctions that have been imposed on Russia? What would it mean in terms of Russia's isolation from the global financial system? This is obviously a key question today. This as we wait payment on some key dollar bonds that Russia has coupon payments due. We've got a euro bond due as well. The rating agencies are making it very clear that if payment is not made, that we will see a default. Let's try and get an idea of what is happening here. Joining us now is our chief emerging market strategist over at Bloomberg Intelligence, Damian Sasser. Damian, the understanding at the moment is that a Eurobond payment earlier on was made, but the financial plumbing didn't allow it to be paid. Can we assume that the same thing is ultimately going to be happening here when it comes to the dollar bonds as well?
Yeah, so let's take a step back. I mean, look, to be very clear, I've talked to a lot of investors. OFZ's Russian local debt, coupons have had to been paid on that. They haven't been paid yet. So Guy, I know the local bonds are a little bit different, but Russia's still not paying its foreign creditors the rubles that they're deserved. So now going to the dollar bond market, Russian corporates from GTLK, Russian Rail, Gazprom, Rosneft have all paid principal and coupons to their foreign creditors in dollars to date. Today's $117 million in coupon payments that the Russian government itself owes to dollar creditors is under discussion. And what I'm hearing is Finance Minister Sulanov is trying to make that payment, but because Clearstream and Euroclear have cut Russia off from the global payment system. They cannot make that payment. So what they've tried to do are create these Type C accounts where foreign creditors have to open up an account in Russia in order to collect payment. But once it's there, they can't repatriate those dollars. So it's a blocked account effectively. So this is what creditors are trying to wrap their brains around here on a Wednesday morning.
Right. It's not that Russia doesn't have the money. It's just that it can't use it. Now, correct me if I'm wrong. If they do indeed default, there is a 30-day grace period.
Correct.
So could we see things change during that time?
Absolutely. Well, GTLK didn't pay until yesterday. Their payment was due on the 10th. So yes, they're all kind of trying their best to get what dollars they can, either offshore, however they can get their hands on it, get it into the clearing system to make payment to their creditors. But yeah, I mean, it's going to be an interesting 30 days for certain, given some of the headlines that, Guy is rightfully pointing out here about, maybe a little bit of a de-escalation in Putin's war in Ukraine.
Were there to be a default, Damien, what would be the long-term implications?
Well, I think the long-term implications are clear to me, Guy. I mean, Russia is a pariah. Investors are not going near it. In fact, the last print we saw on many of these bonds, including the bonds that are due today, were 20 cents on the dollar. My sources are telling me that, big fund managers have marked those bonds all the way down to 5 cents on the dollar. So, clearly people, investors are preparing for the worst case scenario.
Well, talking about maybe not the worst case scenario, let's shift to one of the other markets I know you watch closely, and that is China.
Yeah.
What are your thoughts on the verbal intervention we got out of Beijing overnight?
Well, it's interesting because it's the first time that China's highest economic and finance head basically made, where he addressed all four major issues affecting investors all at once. And so I'm talking about stable capital markets, the ADR issue here with foreign listings, property curbs, the crackdown on big tech, all at once. What's interesting here, though, for me is, that big rip we saw in Chinese equities, you could, call it a short squeeze. You could call it plunge protection buying. You can call it a lot of different things. At the end of the day, markets were severely oversold, not just in China, but globally. So I think a lot of this is kind of, I don't want to say a dead cat bounce. I hate that word. But yeah, I mean, maybe a little bit of bloodletting here was in order.
Damien, is there any action behind these words? Just very briefly.
Well, Guy, I do not see China adhering to FASB, to the U.S. Accounting Oversight Board as it relates to many of the companies that are listed in ADRs here in the U.S. I just don't see that happening anytime soon. There's been no real progress on that front, despite what you would hear otherwise over the last 24 hours. And I think that's a real key issue here. And that's why you're seeing the Golden Dragon Index, why you're seeing ADRs really still under pressure amidst it all.
All right, Damien Sassower of Bloomberg Intelligence, thank you so much for your great expertise. Now, coming up, we'll talk about China. We'll also talk about the Fed. The CEO of Marathon Asset Management, Bruce Richards, is joining us next. He thinks the Fed will move 8 times this year. What that means for credit, this is Bloomberg. We're an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, we still have a while to go until that Fed decision, but the equity market is already making its move.
It is certainly making its move, Kaylee, and it looks like it may stick. We have this relief rally in place for a second day. In fact, the S&P 500 right now on pace for its best 2 days since the end of January, up more than 3.5%. You can see also some nice gains for the NASDAQ 100 and the stocks. But it is this Golden Dragon China index that Kaylee and Damien and Guy were just talking about. It is extraordinary, up 25% in 1 day. To my memory, I cannot remember another index up 25% in 1 day. That's the best day ever for this index, not surprisingly, on that rebound. Whatever's behind it, the oversold, the talking out of Beijing, relief rally, there it is for sure. Now, of course, the Fed is ahead. Let's take a look at the 10-year yield because it is up a little bit on the day, but over the last several days, there's been this massive backup. It does look like there could be some consolidation. You can see roughly an uptrend here, and then you can see a range. It would not be surprising to see the 10-year yield fall back toward the bottom of that range around 175. Should that happen, it might suggest the Fed could somehow, in some way, be a little bit more dovish than what investors are looking for, even if that does include the 1 rate hike that, of course, everybody's pricing in, and a chart of the S&P 500 that we took a look at last week that shows a bullish divergence may also support this idea that the Fed could be dovish. Take a look at the RSI, or momentum indicator, on the bottom. We see higher lows. The S&P 500 has these lower highs. That bullish divergence may suggest you could just see that S&P 500 on the bullish momentum, Guy, climb, let's call it 4,600. It'd be a nice relief rally in what does seem to be, though, a more bearish context on the year.
Absolutely. How dovish, how hawkish will the Fed be tonight, Abigail? Key question. Let's try and get an answer to it and figure out where we go from here. The last time we spoke to him, he said he expected 8 Fed rate hikes over the course of this year. Joining us now is the chairman and CEO of Marathon Asset Management. He, of course, is Bruce Richards. Bruce, great to have you on the show again. Talk to us about where you are in terms of expectations for the Fed right now. You've been pretty hawkish in the past. You expect Jay Powell to be hawkish tonight. What do you think is going to happen?
It's pretty remarkable. I mean, think back just a second to reflect. It was exactly this meeting, exactly 2 years ago, March of 2020, when Powell brought down rates 100 basis points and embarked on a QE easing program that led to $5 trillion of printing of money. And so here today we are with inflation raging out of control at 8%. We've never seen ever in the history of this world rates at zero with inflation raging like this, having gone from sub 2 to 8%. So the Fed is so far behind the curve. I think what he says in his language is going to be to calm markets, but what he has to do is control inflation. And so every meeting this calendar year, he's going to have to raise rates.
Well, Bruce, if the Fed is as behind the curve as you say, will 25 basis point hikes do the job?
But he's already showed his hand. He's already told you at his last correspondence that, which is, I don't think you're supposed to, show that hand then, but he did. They said 25 basis points. So that's in the market. That's what we all expect. That's what it will be. But what's more important than that is kind of what comes next, which is a tightening at every Fed meeting over the course of the next year. And in one calendar year, you have 8 meetings. And so there's 7 left this year. So every meeting this year and into next year, a tightening expected to get Fed funds where it should be, which is 2 to 2.5%. And mixed in there, you'll see a couple 50 basis point increases. And, you know how bad inflation is when even Tom Brady comes out of retirement, right? So
don't get me started on that, Bruce.
But it's not only Tom, it's like every household's feeling this. It's food, fuel, housing, all goods, all services. Every company on every company call we talk to, is talking about inflation and talking about their cost of inputs, cost of manufacturing, cost of labor. And so it's spilling through. And what I say also, Guy Cayley, is that when you have the first, second, third, and fourth, it's not going to be problematic for the markets. When you have that 5th, 6th, and 7th, that's when the financial conditions tighten enough. And that's when the pain's going to be felt in the marketplace. So when I think about markets, I look at the equity markets, where they are now, properly priced at, say, an 18 multiple. I think for the high for the year won't get you back to where you started the year at 4,800. I think it'll probably get you around 45 or 4,600. You're supposed to sell into that. I think at some point this year, later this year, as conditions really tighten, you can look at wiping out all of 2021 gains, which is getting the S&P back down to 3,800. As it relates to credit, it's the worst start for credit and the worst start for fixed income that we've seen ever, with high yield down 6% thus far, IG down 9%, emerging markets down 12%. And there's also really good opportunity with the coupons that they provide to be able to buy credit at very, very cheap valuations.
Bruce, when we talk to the asset managers, when we talk about the idea that you should still be fully invested, they say absolutely 100%. You need to be fully invested in this market. When you ask them about cash and how big a part of your portfolio should be cash right now, they pull a face because they say that you should not be in cash. What do you think cash does to a portfolio right now? Do you want to be in cash? How much cash do you have? What are you thinking about when it comes to cash?
Well, in the public markets, in the credit markets, our book is yielding in the liquid markets, 5, 6, 7%. And you take a look at emerging markets, when you take Russia out of emerging markets, which comes out of all the indices at this month end, you're talking about being down 12% on the year with a 7% type coupon. And so we think when that market recovers, it could be up 15, 20% total rate of return. That's the liquid markets. In the private credit markets, because we provide a lot in the private credit markets in the form of, lending and the form of capital solutions. And I think buyouts is going to be a big year because equities are down and the leveraged loan market, floating rate assets, people like. And so we're able to provide all kinds of financing to the buyouts. And so I think it's going to be a big year for buyouts in private equity because of attractive multiples. And and how open the leveraged loan market is. And so our capital solutions business, our asset-based lending business is a double-digit type return with very low volatility. And so I wouldn't be in any cash. I'd be taking any cash I have and finding private investments, both in private equity and in private credit, and deploying cash that way. As it relates to the liquid markets, look, you have to be able to trade. I think this is a trader's market. And so I think there's times to be in cash. And when the equity markets go up, and you're talking about 4,600 S&P, you're supposed to let go of a portion of your equities because you'll be able to buy them back 15% lower before this whole Fed tightening cycle is over. So I think it's a trader's market, a lot of volatility. Cash isn't going to earn you anything. It's going to get eaten by inflation. There's a lot of very smart things to do.
All right, Bruce, so if you don't want to be in cash, another place where it hasn't been fun to be for the last couple of weeks is anything that touches Russia. What can you tell us about your Russian exposure?
Well, Russia exposure here at Marathon, look, we manage some index products. It's part of the index. It's coming out of the index. Ex that, we have no Russia exposure. And so we're very proud of the fact that we were defensive as it relates to Russia. And, listen, Zelensky is the person of the year. And I think, teaches all the world leaders what it is to be brave and to have vision. And so watching him address Congress this morning to a standing ovation was amazing. But this is Putin's war, and Putin has turned Russia into a very difficult place to invest. Some characterize that as a pariah country, and we don't want to have any capital deployed in Russia. So there's other places for us to go. What I'd say is, you just look at what happened yesterday with the nationalization of all the airlines. And so there's 523 planes that the West, U.S. and European investors have unleashed with Russian airlines, and all those planes have been seized, all 523 of them. And then on top of that, Putin yesterday signed a decree to nationalize the Russian airlines. So which other industries is it also going to nationalize? Marathon has a nice-sized aircraft leasing business, and we don't have a single plane in Russia, not a single plane on lease to any Russian companies. And so I'd be very cautious with Russia. I don't think the West should be deploying capital there. And I think the defaults, and we talked about this earlier today in our call, with Euroclear and the freezing of and sanctions and regulations and the freezing of their capital, the Russian sovereign overseas, the default's going to be rolling in one after another after another. It'll take a few weeks yet, but sometime in the second half of the second quarter, so you're talking about May and June, you'll see default after default after default hit. As the West has characterized Russia as a pariah country.
Bruce, let's turn our attention to China. Chinese stocks are coming roaring back today after being battered for quite some time, but nevertheless, a massive rally as the Chinese authorities seem to get in behind the Chinese asset markets and say that they have their back. What do you think about the Chinese economy? Are you allocating cash there? What do you think of it right now? And do you think a rally like we're seeing today has legs?
So, yes, I think the rally has legs, but and I'll tell you why in just a second. So Chinese economy, asked about that, growing at 5%. The Chinese government is lowering rates, not raising rates. So they got ahead of that curve, and they're making those adjustments. And He, who's the vice premier to President Xi, came out and made some very bold statements today, and it's going to help Chinese tech, Chinese economy. But he talked about the easing of regulation. He talked about we'll have to see what follows up with that, but the easing of regulation and the support that the Chinese government is now going to provide both markets as well as the economy. And he's very clear, Vice Premier He, who is the second in control in charge of all economic policy in China, was very clear to say not only the economy and housing, but markets. And so with that, ADRs have ripped it. I wouldn't want to be those folks that capitulated yesterday and the day before, selling their ADRs, selling their Chinese holdings in the hole, because I think we're in recovery mode. They came in very, very cheap on a valuation basis. And what you were worried about is geopolitical risk. And you were also worried about, taking regulations which would further prohibit these companies from prospering. And they've come out and made some very bold statements they hadn't made in the past. So I think those folks that sold will definitely regret that. I think this move that we're seeing this morning will have legs, but this is the initial jump of that. It may retrace some of that, but over time, I think it will improve as the Chinese government realizes that they don't want to destroy their private companies.
All right, Bruce, unfortunately, we have to leave it there. Time is always too short, but thank you for giving us your time this morning. That's Bruce Richards, Marathon Asset Management Chairman and CEO. This is Bloomberg.
This is Bloomberg Markets. I'm Justin Morton, and you're looking at a live shot of the Principal Room. Coming up tonight on Peer-to-Peer Conversations with David Rubenstein, Airbnb co-founder and CEO Brian Chesky. This is Bloomberg. Keeping you up to date with news from around the world, here is the first word. I'm Justin Morton. South Korea says that North Korea's latest missile test appears to have failed. That comes days after a report that Kim Jong-un's regime was planning to fire its first ICBM in 5 years. The South Korean military says the missile is presumed to have failed shortly after launch. The Kremlin is hinting at a possible progress in peace talks with Ukraine. A Russian spokesman says that a Ukrainian proposal to become a neutral country but retain its own armed forces could be viewed as a certain kind of compromise. Talks between the two sides are underway. The president of Ukraine made a dramatic appeal to Congress for more help fighting off Russia. On a video link, Volodymyr Zelensky invoked 9/11 in the attack on Pearl Harbor, and he pleaded for U.S. help in clearing the skies of Russian warplanes.
Russia has turned the Ukrainian sky into a source of death for thousands of people. Is this a lot to ask for, to create a no-fly zone over Ukraine to save people? Is this too much to ask? Humanitarian no-fly zone.
President Biden has rejected the idea of a no-fly zone. There's concerns it could escalate the conflict into a war between two nuclear-armed nations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Justin Morton. This is Bloomberg.
Justin, thank you very much indeed. Let's pick up on where Justin left off. We need more on Ukraine. Let's go now to the European Commission Vice President, Maroš Šefčovič. Commissioner, thank you very much indeed for joining us. There are various reports today floating around, and the FT has it on its front page right now, the Financial Times. Ukraine and Russia draw up a neutrality plan for Ukraine to end the war. Austria and Sweden are both neutral countries. They are both members of the European Union. If we see neutrality for Ukraine as being the way forward to peace, would that rule out the possibility of Ukraine joining the European Union?
I think first and foremost, we all have to admire the skill of President Zelensky and his courage, not only in leading his people, but also to form the public opinion about this atrocious war in Ukraine, and his ability to bring it really to our living rooms and to make sure that we do everything possible to stop this terrible war and help Ukraine to develop, to rebuild, hopefully rather sooner than later after this conflict. And of course, we have to support Ukraine in getting good peace. And I think the good peace for me would be something which should be supported by Ukrainian leaderships and by Ukrainian people. And as you know, we stated very, very clearly that Ukrainians brought such sacrifices for fighting for European ideals and European values that they clearly demonstrated they are part of European family. And of course, I would like to see them to be part of family rather sooner than later. And I think that we should do everything possible to make sure that we will prepare them well for the next week, next month, and also for the European perspective.
Well, speaking of doing everything possible, is the European Union doing everything it can to support Ukraine in the ongoing conflict? What else can it do?
I think we just approved 4 packages of sanctions, I would say, of unprecedented scale. and on unprecedented pace. Because if you look what's happening with a Russian economy, and I think you just reported on it a few minutes ago, the ruble is crashing, stock market is closed, European companies are delisted, assets of the Central Bank of Russia are frozen, their planes are not flying, their ships are not sailing, and we just adopted strategic decision to reduce our dependency on Russian fossil fuels, which is a major source of income, by 2/3 already by the end of this year. And on top of it, what we are doing for Ukrainians is, again, unprecedented support materially. For the first time, European peace facility is used, and I'm talking about €500 million, not only to help with non-lethal, but also lethal equipment to help the Ukrainians to defend for themselves. And the last point I would mention, because it's a very human one and it's a very important one, we open our arms to currently more than 3 million of refugees, women and children coming from Ukraine, especially to Central Eastern European countries. As you know, I'm from Slovakia, and I never thought that we would have on our soil within 2 weeks 180,000 refugees, and the Poles are almost approaching 2 million. So this is, I would say, unprecedented show of solidarity, and we are permanently looking what more we can do.
Okay, well, let's talk about what more you could do. Mr. Šefčovič, would the European Union be prepared to guarantee the security of Ukraine in a peace deal?
I think that we will, of course, explore all the possibilities. What I can tell you is that we are already right now thinking together with the United States of America. That's part of my visit here to really further strengthen this stellar transatlantic bonds, which I think again been demonstrated how important they are over the last 2 weeks, and to already think how can we not only stop the war but rebuild the Ukraine, to build again the houses, apartment blocks, to give the investors confidence to go back, and also to create the future for this young generation. And of course, we will be discussing with our allies what more we can do to guarantee the Ukrainian stability and Ukrainian peace. Unfortunately, here we are dealing with a very tough real politics situations, because there was a Budapest agreement, there have been, the Paris Charter, and all this was violated by Russia. And therefore, I think we have to learn from the experience and make sure that next time when we will be building this new global and European peace and security architecture, we have to be much stronger in that respect.
Mr. Šefčovič, we're short on time here, but of course another difficulty is the European Union's energy dependence on Russia. Is an oil embargo like the U.S. Has undertaken entirely out of the question for Europe?
As I said, we decided just a couple of weeks ago that we are going to reduce our energy dependency by 2/3 by the end of this year. It's an enormous task, because if you look at the prices we are already paying in Europe, it would represent, so the American viewers would understand it a little bit better, something like $12 per gallon. Our electricity is currently 6 times more expensive, gas 9 times more expensive than here in the United States. But nevertheless, we clearly said and demonstrated we are going to get rid of the dependency on Russian gas. And my request here was, let's work very closely with our American partners. We need LNG. We need 60 to 100 BCM. We need to work together on energy security. And I believe that the goal to get rid of this dependency on Russian fossil imports is clearly our objective, and we will achieve it.
All right, we have to leave it there, but thank you so much for your time today. Maroš Šefčovič, European Commission Vice President for Interinstitutional Relations. Thank you. This is Bloomberg. We have breaking news out of Japan. A 7.3 magnitude earthquake has hit off of Fukushima, and a tsunami advisory has been issued. This is according to NHK, Japan's public media organization. But again, a 7.3 magnitude earthquake, Guy. This is a very big quake, and we understand it's shaken buildings in Tokyo.
Absolutely. So 2016 Fukushima, that was initially reported at 7.3, then upgraded to 7.4. We know the damage that caused We need to watch and see what the impact of this is going to be. Clearly, the Japanese have made significant advances in terms of dealing with such quakes, but nevertheless, this is a huge quake. This is a major earthquake that has just hit Japan. This is Bloomberg.